Window dressing in accounting, it's a term that might sound harmless, like sprucing up your living room before guests arrive. But in the world of finance, it's a practice that can have serious implications. Imagine a company polishing its financial statements, making everything look shiny and bright, but underneath, the reality is far less appealing. Today, we're going to peel back the layers of window dressing, understand what it is, how it works, and why it's crucial for both businesses and investors to steer clear of this slippery slope. First off, let's break down what window dressing actually means. At its core, window dressing refers to the practice of adjusting financial statements to present a more favorable picture of a company's financial health than what's truly there. It's like putting on a fresh coat of paint to hide the cracks in the wall. Companies often engage in this behavior at the end of reporting periods, like the end of a quarter or fiscal year, when they need to showcase their performance to stakeholders. Now, you might be thinking, what's the big deal? Isn't everyone just trying to look good? Well, here's where it gets tricky. While window dressing isn't outright illegal, it's certainly unethical. It creates an illusion of stability and success that can mislead investors, creditors, and regulators. For example, a company might decide to temporarily reduce liabilities or overstate assets just to meet performance targets. This can lead to a significant loss of trust if the truth comes out, and trust is everything in business. Let's take a moment to clarify what window dressing isn't. It's not the same as cooking the books, which implies outright fraud. Window dressing can be more subtle, involving techniques like recognizing revenue before it's actually earned or deferring expenses to make profits look better. It's also a misconception that only struggling companies engage in window dressing. In reality, even well-established firms can fall into this trap, driven by the pressure to meet expectations or maintain a favorable image. So, where did this term come from? It actually has its roots in retail. Think about how store owners arrange their display windows to attract customers. They want to present their best products in the best light to entice shoppers. In finance, companies do something similar with their financial statements, trying to create an appealing image to attract investors or satisfy stakeholders. Unfortunately, this practice has been around since the early days of accounting, and with the rise of computerized systems, it's become easier for companies to manipulate their financial information. How does window dressing relate to accounting? Well, it often involves tactics like early revenue recognition, where a company records income before it's actually received. For instance, if a company signs a contract but hasn't delivered the product yet, they might still recognize that revenue. Another common tactic is deferring expenses, pushing costs into future periods to make current profits appear healthier. There's also the issue of moving liabilities off the balance sheet, which can make a company's financial position look stronger than it really is. Let's look at some real-world examples of window dressing in action. Picture a portfolio manager who's underperformed for the year. As the year end approaches, they might buy high-performing stocks just to show off a better portfolio before the final report. Once the year closes, they sell those stocks, returning to their usual holdings. This short-term manipulation can mislead investors about the manager's capabilities. Another example is an investment manager who manages a mutual fund tracking the S&P 500. At the end of each quarter, they might sell off underperforming stocks and buy high performers to make the fund's performance look better. This doesn't reflect the underlying performance over the long term, but creates a misleading snapshot that can attract new investors. Now, let's talk about the impact of window dressing on financial decisions. On the surface, it might seem beneficial, creating a favorable impression that can boost stock prices and attract investors. However, this facade can lead to poor investment decisions based on inaccurate information. Investors might put their money into companies that appear stable but are actually teetering on the edge of financial instability. Moreover, window dressing can erode trust in the financial markets. If investors catch wind of these practices, they may become hesitant to invest, fearing that they can't rely on financial reports. This lack of trust can ripple through the economy, impacting overall financial health. So, who engages in window dressing? It's not just the executives and managers of companies. Auditors can sometimes play a role, creating a false sense of accuracy in financial statements. Investment bankers and analysts might also engage in window dressing when recommending companies to clients, highlighting positive aspects while downplaying negatives. Now, let's talk about where window dressing is commonly found. It's rampant in various industries, from banking to retail. Companies may manipulate balance sheets, manage earnings, or even engage in window dressing during mergers and acquisitions to attract potential buyers. Regulatory compliance is another area where companies may feel the pressure to present a favorable image, leading them to engage in these practices. What are the techniques used in window dressing? Timing of transactions is a big one. Companies might deliberately shift when they recognize revenue or expenses to alter current results. Accrual accounting can also be misused to recognize income that hasn't been earned yet or inflate asset values. Off-balance sheet financing is another tactic, where companies move liabilities off their balance sheets to present a healthier financial picture. Now, is window dressing illegal? The answer isn't straightforward. In some jurisdictions, engaging in misleading financial reporting can lead to severe penalties. In the US, the SEC has regulations against such practices, and companies can face fines or even criminal charges. However, in other countries, the penalties might be less severe, but the ethical implications remain significant. The impact on investors and shareholders can be profound. While window dressing might temporarily improve a portfolio's appearance, it can lead to long-term consequences. Investors could be left with a false sense of security, making decisions based on inflated performance. If the truth comes to light, it can damage the credibility of portfolio managers and investment firms, leading to a loss of business and value. So how can investors and stakeholders protect themselves from the effects of window dressing? First, conducting thorough due diligence is crucial. Always review financial statements and look for any unusual changes. Pay attention to non-financial metrics too. Sometimes the real story lies beyond the numbers. Seeking independent verification from auditors can also help ensure accuracy. It's essential to ask questions. Don't be afraid to dig deeper into a company's accounting practices. Diversifying investments can also mitigate risks associated with window dressing. By spreading your investments across multiple companies, you reduce the impact of any one company's financial misrepresentation. In conclusion, window dressing in accounting is a practice that can create an illusion of financial health but ultimately undermines trust in the financial system. It's vital for both businesses and investors to prioritize transparency and ethical reporting. By understanding these practices and their implications, we can make more informed decisions and foster a healthier financial environment. So, the next time you look at a financial statement, remember not everything that glitters is gold. Stay informed, stay cautious, and always dig a little deeper.